Over the last few days, the S&P has been very mixed. We have some stocks that are up, some stocks that are down. When we do zoom out, for example, and look at over the last 12 months, we can see for the most part, the majority of stocks are up in the green, nearly double digits. And today we are focusing on one company that we would invest in if we had $1,000 in the stock market. That company is Visa Incorporated, which we do see as a very undervalued company. And today we're going to talk about why we believe this is a very strong stock to maximize your gains over the next few years and beyond in the future. We're going to talk you through every single part of this company that we like, why we believe it is a very strong contender for one of the best stocks in the portfolio and for value right now. We're going to discuss the company's revenues. We're going to talk to you about their bottom line net income. We're going to run through the health of the company. They have a very strong balance sheet, so we want to talk about how their cash compares to their total debt. We're also going to talk about not just the dividend safety, which we can see is very safe, but why this is a great company with long-term growth on that dividend, nearly double digit every single year. And we'll also talk to you about the metrics, what we love about this company. We really want to highlight this as the gold standard, so you can also look at your own companies to see whether or not they are up to scratch with Visa as well as their future anticipated performance. And we're going to talk about their latest quarterly report as well, why this company has some massive growth in the future as well, not everything that is just historical performance based. And ultimately, we're going to talk about the valuation, why we believe it deserves that $1,000. We're going to talk about the intrinsic value, what are acceptable buy prices, what sort of margin of safety we are looking at, and ultimately we will discuss whether or not Wall Street also see this as a company that has a lot of upside that you should really consider for your portfolio. First thing to note then, it does get a double buy rating from Seeking Alpha and Wall Street with a hold from Quant. It has cooled down from its all-time highs of $291, now sitting at $265, and it does have a forward yield of 0.78% and a forward P of just under 27. Now bear in mind, whilst the S&P does sit around 22.5, we're going to look at how it compares to the sector to get some more relevancy. And over the last 12 months, it is up 17%. Over the last 10 years, up 391%. And if you have been a shareholder over the last 10 years, you will have outperformed the S&P quite significantly, which we are going to come on later just to visualize that as well. Then move on to the top line of the company. What we want to see with companies, 3 to 7%. On top of that, we want to see consistent growth year on year. What we get from Visa, a lot better. 12.7 billion on their top line in 2014. 33 billion in that latest annual accounts. So we can see they've more than doubled their top line over the last 10 years. In fact, nearly tripled it. And we can see graphically as well the consistency over the longer term. Other than that COVID year that we get, September 2020, which is justifiable, it has had consistent increases over the longer term. Now later on in the episode, we will look at the percentage increase as well, but you do start to understand why we are talking about a high quality company. The same can be said for their bottom line. 5.4 billion in 2014, more than tripled over the last 10 years, 17.3 billion in 2023. That is their latest annual accounts. And graphically, again, we can see that consistency over the longer term, moving in the right direction, both top line revenue as well as bottom line net income. We then take a look at the health of the company. Very important to understand, doesn't just correlate to essentially their dividend safety, but you want to be investing in companies that over the longer term will not be taking on a ridiculous amount of debt and suffering in 5 to 10 years. And what we can see, just under 4 billion of cash and short-term investments in 2014, 17.7 billion from their latest quarterly report. So we can see more than 4 times growth, just like their other metrics, revenue, net income. Over the longer term, their cash position is also increasing. Now, in terms of how important that number is, if you look at it on its own, not that much, which is why we always take a look, compare it to their total debt, and we can see that it has increased. They had no total debt in 2014. What we notice now, 21 billion on that balance sheet. So we can see their cash and total debt aren't that far off each other, and similarly their total debt over longer term has increased, although we can say marginally. So lots of things to consider here. One of the things that we do quite like about this company is that consistency overall, and we're going to come on to their debt levels, what that net debt to EBITDA metric looks like, which is very important as well. One part of our analysis that we like to cover is both historical performance and accuracy against future projections. Now, over the last 4 quarters, we get a bit of confidence with their management's targets and analyst target as well, because what we do see is they have beaten 4 out of the last 4 quarters, so 100% track record. And over the next 3 quarters, they are anticipating double-digit increases to the year-on-year earnings per share, which is very strong. That is what we do like to see. September 2025, if they hit that EPS target, which if you do have confidence they will, that forward PE will sit at 23.8. So that is coming more in line with the S&P. So again, it does depend on what you see moving forwards and if you do have that confidence in terms of management. So what we're looking at here then is their valuation. Now it doesn't look great. The reason for this, they get an F. What this does here, we'll compare it to the sector median. So on average, what we can see here, whilst Visa currently has around a 26, 27 forward P on a non-GAAP basis, the sector median at 10.47 is a lot lower. So for Visa, you are paying a premium of 156%. We're going to come on to this episode and answer the question why we do believe it is massively warranted for a company like Visa as opposed to others in the industry that are around that 10.5 level. And again, you can see the general theme here. On any other valuation method you look, they are trading at a massive premium. So in terms of the growth, they get a B+. What we can see, revenue growth 10.2% year on year historically. Sector median 4.43. So we can already see in terms of a year on year, they are outperforming the sector. In terms of forward looking, double digit at 11%. We can see the sector mid-single digit at 5%. And one of the things that we really like to look at here is in terms of the earnings per share over the next 3 to 5 years, Visa is anticipated to increase 13.22% year on year, with the sector median marginally lower, 9.45, or if you want it in percentage terms, just under 40% lower. We then move on to profitability, which is one of the best areas of this company. Again, a lot of this will be covered when we do look at it graphically as part of it later in the episode. They get an A+ on profitability, 98% gross profit margin, sector median just under 60%. Bottom line, that is absolutely phenomenal. 54% net income margin, sector median 23.11. So we can already see why this is trading at essentially a premium. On top of that, cash from operations just under 21 billion, sector median 155 million. So hopefully we have answered some of those questions. Again, we will continue throughout the episode, but what we can see in terms of a conclusion for this part of the analysis, a double buy rating, seeking alpha Wall Street with a hold from quant, F on valuation, B+ on growth, A+ on profitability. Next thing we want to look at is historical performance against others in the sector. We have MasterCard, a well-known competitor, as well as a few others. Now again, past performance is not an indicator for future performance, but always good just to add as one level of review. Now total return, so including those dividends reinvested, even though that yield is sub 1%. Visa around 18%. Over the last year, it is in the middle of their competitors. When we expand it over the last 5 years, we do see them there right up top next to MasterCard and Pfizer, 61%. We then look at it over the last 10 years, we can see it is up 426%, again up there within the top 2, top 3. Now what we would say is, yes, past performance is an indicator for the future, but we can see historically this company has been very strong, and we're about to find out now. Clearly you'll be able to see it has outperformed the S&P. What this effectively means, your investment would have been up 426% if you'd invested 10 years ago today. Now, the first thing you may have asked when watching this episode is, why would you not just invest in the S&P 500? But as we're about to show you, over the longer term, this company has outperformed. Over the last 12 months, though, we can see marginal underperformance. Visa up 18%, S&P up 25%. When we expanded over the last 5 years, again, a very similar scenario that we can see here. Over the last 10 years, though, we can clearly see Visa has significantly outperformed the S&P. So the first question is, has it historically outperformed over the longer term? The answer is yes. Second part of that question is, do you believe over the next 10 years and beyond it will outperform as well? Now, in my opinion, I do believe that. We're going to run through the metrics. We're going to look at forward guidance. There is no reason why it will not continue to move very strongly, especially against the S&P. So what we're going to have a quick look at now before we jump into their dividend safety is just to look at their latest investor presentation. Few things that we do want to highlight. Now this is the year-on-year comparison of how their latest quarter was on a year-on-year basis. What we want to highlight here, both on a non-GAAP basis as well as a GAAP basis, they are up 10%, double digit, which is what we have come to get used to with this company. It does increase at a very nice rate. Long term, we also get that consistency. These aren't one-off numbers. We also want to point out here that on a year-on-year basis, they are essentially up 17% on the net income, as well as 20% on the earnings per share on a non-GAAP basis. And when you look at some of their KPIs as well, we can see other than their payments volume, the rest are also up strong double digits. Now, forward guidance, this is always very important. When we look at their next quarter, they are anticipating that revenue growth still to be double digit, but lower. In terms of essentially their earnings per share, again, higher end of the low double digit, and pretty much the same for the full year. Double digit, even though it is low, is still very, very strong. One of the things that we have come to love with Visa, and one of the reasons why we do believe over the longer term it will continue. There are no signs of this company slowing down by any means. Now, before we continue, we just want to let you know we have released our latest free weekly article. We talk about 10 undervalued stocks with absolutely phenomenal balance sheets. If you want access to this or any other articles, all completely free, do click on that pinned comment below and you can start reading straight away. Now, as part of our analysis, typically on this channel, we also take a look at insider and institutional movement. So just for consistency, we will do that. What we can see, 6 insider sellings over the last 12 months. Just over 66 million, so quite a lot. And in fact, we can see over the last few years and the last few quarters, a lot of insider selling. So it is pretty much something that does happen on a regular basis. When we take a look at the more recent period to understand who these insiders are, what we can clearly see, an insider, Paul F, in fact, on the 15th of May, did sell just over 25,000 shares, and we do see for $7 million. Now, again, we don't really call this a bearish scenario, management sell, insider sell, personal financial reasons, that it is something that has happened over the years whilst this company has continued to flourish. But again, we do always show this just for full transparency. Same thing to be said about institutional ownership, 82% as we can see here, around 50 billion worth of sales by the institutions over the last 12 months. A lot more buying over the same time period, and we can in fact see that quarter 2 was the largest buy. However, in the more recent quarter, we do note that institutions have sold more than they have bought. So overall, for this part analysis, we do see selling by both insiders as well as more selling than buying by institutions, but we always say to do your own due diligence and never copy essentially what any of these people do one way or another. So in terms of their dividend safety, well, 99, very safe. That is the highest score obtainable. Market cap, 533 billion. This is a mega cap company. And what we can in fact see is that it was reaffirmed just last month. It is very safe, meaning a dividend cut for Visa Corporation is highly unlikely. Now, in terms of some key metrics, we do take a look at how they performed in the Great Recession 07-09. They in fact increased the dividend and they had plus 9.5% growth. Bear in mind, S&P at that point was around negative 12. Now, one of the reasons we love this company for that dividend growth, double digit just last year, double digit over the last 5 years, and double digit over the last 10 years. Things we love to see. And also they have been increasing those dividends for the last 15 years. Now, if you're new to the channel, we always incorporate this dividend yield theory into our analysis. It states the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, although we note we have a double undervaluation signal today. Forward P 25.4 does sit below the 5-year of 28.9. And as we mentioned earlier, it does currently sit higher than the financial sector of 11. Do bear in mind though, we don't look at any one of these models in isolation, and we do normally conclude towards the end. The next thing we look at is the free cash flow payout. As always, we ignore the earnings, which is susceptible to manipulation by management through accounting. Below 60% for this metric. Main reason why gives us faith they will be able to continue to offer double-digit increases, which we can clearly see here every single year, pretty much nearly below 20%, 19 in 2023, 20 over the next 12 months. So we would be absolutely shocked if we don't see another double-digit increase next time. In terms of the free cash flow, very, very important. We want companies that increase their free cash flow consistently over the longer term. That is what we see with Visa. A little bit of inconsistency here and there, but overall we can see pretty much more than tripled over the last 10 years. And we can see 2024, it is anticipated to continue that upward trend. In terms of sales growth, well, pretty much what we said, nearly double-digit increase every single year over the last 10 years, other than that justifiable COVID 2020 year, 11% in 2023. And as we just saw earlier for their full year guidance, they do expect double-digit growth again consistently. So numerically, what we just covered earlier, so another format. On top of that, they return a lot of excess cash to shareholders, not through those dividend increases, but also through those share buybacks, as we can see pretty much consistently, not a lot, but consistently year on year, which is always a great sign to see. Next, we move on to the ROIC, one of the most important metrics. 10% or more is what we want to see. Give us faith that management are able to effectively allocate their capital. Very strong numbers across the board. In fact, increasing over the last 10 years. 34%, very, very strong, making it incredibly attractive for investors as well as potential investors. We then move on to the margins, very important. We want above 12%. What we see for Visa, absolutely phenomenal, 64% in 2014. So we have a sign of operational efficiency. It has increased over the longer term, 67% over the last 2 years. And remember, one of the key things we look for on this channel, companies that increase both their top line revenue as well as their margins. And we can clearly see as well, free cash flow looking absolutely gorgeous over the last 3 years in the low 60s as well. This company is a free cash flow machine. In terms of the net debt to EBITDA, again, this is important because it correlates to balance sheet strength, dividend safety. The EBITDA referring to the earnings before interest, tax, depreciation, amortization, and below 3 is what we want to see on these numbers. Bear in mind, these numbers refer to the number of years it would take the company to pay off all of their debt net of cash on hand. 2023, 0.05, incredibly low. Over the next 12 months, a very marginal increase. So this company has a phenomenal balance sheet. No surprises as well, that dividend does look to be safe. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you're continually notified of these videos as they drop. The first model that we use is the multiples valuation. Now, ideally, we like to have a few included in here. However, we do believe MasterCard is really the only one that is comparable. We get the PE multiple multiplied by the EPS of Visa, and we get an intrinsic value showing that it is undervalued with some nice upside. Bear in mind 2 things. One, we don't look at any model in isolation. And the second thing to note is that it essentially shows that MasterCard is trading at a higher forward PE. We then move on to the next model, the dividend discount model. Very nice average growth, just under 16%. Forward looking, we've gone very low at 7.25 just to be conservative, and again we do get another undervaluation signal. We then move on to the DCF model where we have the free cash flow year on year. Average growth rate just under 17%. Forward looking, we've gone for a very conservative number, 8% lower than both the average as well as the last year's increase and lower than management estimate. With that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by those shares outstanding, and we can see here another strong undervaluation signal. So in terms of the intrinsic value today, it is the average of these 3 models. Do bear in mind as well, you can grab a copy of this model by clicking on the pinned comment below, running in your own numbers, whether it's for Visa or any other company. So our intrinsic value at $319, price around $265. What we typically do, start off with a margin of safety of 10%, and we execute on this if it meets our 3 golden criteria. A wide moat, strong financial metrics, good forward-looking data. If you believe this for Visa, well, it is a buy around $287. Then we keep going till it's near the current trading price. Now, in today's episode, it isn't at that 20% MOS level just yet. We see at least a 15% margin of safety for what we would say as an incredibly high-quality company that has outperformed the S&P in the past, and we do believe over the future as well, it will continue to do so. In terms of Wall Street and their price estimates, well, they believe the forecasted target of $316 over the next 12 months gives implied upside of 19%. And as we said, they do consider this a buy for the portfolio. It isn't also too far off our intrinsic value. As always, if you have enjoyed the content, value was provided, smash that like button, hit that subscribe and bell button. Let us know your thoughts in the comments below. And as always, we'll see you all on the next one.